we are looking at these advanced methods of handling risks through what here? Uncertainty. Of which in our very last class we discussed which method? Simulation. Any other? Ama ilikuwa tu simulation ndio ilikuwa ya kwanza? Simulation method, I'm told that is the only one that we did. That's number one. But I doubt whether we've only done one. Are you sure you've only done one simulation? Simulation. Yeah, it's only one. Yeah, simulation analysis. So you should have labeled that one. You should have labeled that one. So number one, the first method, in this case here, is what we have called what here? Simulation analysis. Simulation analysis. Great. So then number two, ladies and gentlemen, is what in this case here we shall, no. Haven't we done sensitivity? We have done sensitivity first. We did number one, sensitivity analysis, yes. Sensitivity analysis that we have done. Number two, we have done simulation analysis. And then now today, I would want us to look at what we call scenario analysis. Scenario analysis. So today we are looking at scenario analysis. Scenario analysis. Now, before I look at this scenario analysis, there is something very, very important I would want us to jot down as a recall. That in finance, or a not better also can work here. In finance, if tax is not provided, comma, depreciation is irrelevant. Depreciation is what here is irrelevant. This is really very important for you. That when you go to a question and then realize that this question does not have tax rate, 30% or whatever percentage, then automatically you know that depreciation is what here is irrelevant. It will be very, very important for you to know that. Yeah, depreciation is irrelevant. i.e., if tax is not provided, yeah, in this case here, PBDT will be equal to the cash flow, which will be discounted. If tax is not provided, PBDT stands for profit before depreciation and tax. You can write this in full if this is the first time you're seeing this. Profit before depreciation and tax will be cash flow. You don't have to calculate depreciation and then you start, in this case here, subtraction. No, that will be a waste of time, because at the end of the day, this one will be equal to cash flow. Illustration for you to understand this, because this is the bedrock of this topic here. So for you to understand this, let's look at various questions here. So illustration one, if PBDT is 10, and then depreciation, in this case here, is 3, yeah, and then tax is 30%. Tax is 30%. Tax is 30%. Yeah, so I would want you to calculate for me the cash flow. Please calculate for me the cash flow. Calculate for me the cash flow. Calculate for me the cash flow. Yeah, so we have given profit before depreciation and tax is 10 bob. Depreciation itself is 3 bob. Rate of tax is 30%. Cash flow is what the examiner wants. So solution then, how do we get this very easy thing? To get this very easy thing, our solution, we shall say profit before depreciation and tax of 10, and then we less what here, somebody? We less depreciation first, because for us depreciation is allowed for tax purposes. So you less depreciation of 3, yeah, so this will give me 7. Yeah, so what name do we give to this beautiful number 7? Profit before tax, because already now depreciation has been provided for. So this is profit before tax. So after getting profit before tax, we come and less what here? Tax. And tax, you can see, is 30%. 30% is the same as 0.3. So 0.3 times 7. 0.3 times 7. The online ninjas also expect you guys to be, in this case here, participating. To be participating, very, very important. So tax is 30% and 30% is the same as 0.3. So 0.3 times 7, that will end up giving us what figure? 2.1. Thank you so much, Lincoln. Lincoln Mwangi akiwa hapa sasa, mimi nimepona. 2.1. You subtract. So 7 minus 2.1 gives us what figure? 4.9. What name do we give to this beautiful number of 4.9? After tax, yes. So this is profit after tax. But now the question is, how do we change this profit after tax to cash flow? How do we change this profit after tax to cash flow? We shall add back, yeah, the non-cash items. So add back depreciation. Add back depreciation. Over how much here, somebody? 3. Which will end up giving us what figure here, somebody? 7 point what here, somebody? 7.9, isn't it? So this will end up giving us 7.9. Thank you so much. Thank you so much. Now, ladies and gentlemen, somebody else in this case here may go ahead and tax this number the way it is. Yeah, somebody else may go ahead and tax this number the way it is, method 2. So method 2. Yeah. So in this case here, this tax the way it is, this profit the way it is, you can go ahead and say less taxation, which will be 30% of this 10. Yeah, 30% of 10. 30% of 10, which gives us 3, isn't it? So they subtract like that, which at the end of the day will give us what here, say? 7. So if you're using this approach, remember, there is an element called depreciation, which is tax allowable, but you never subtract it. So if you're using this approach, you'll come and say, add DTS. Who can tell me what DTS stands for? Depreciation, tax shield, yes. Please write this somewhere. And this method, you only use this method whenever you subtract tax directly from profits without adjusting for depreciation. So you'll be able to come and add depreciation, tax shield. You add depreciation, tax shield. Thank you very much, Maslin. So then the depreciation itself, the figure of depreciation you guys had given me, was it 3? Depreciation, it was 3, right? And the rate of tax is 30%. You see 3 times 30% gives me 0. What here, somebody? I think I'm alone. Yeah, 30% times 3 is 0.9, isn't it? Yeah. So at the end of the day, I'll be able to get my cash flow. Of 7. What here, somebody? 7.9, which is the same, isn't it? Which is the same. However, at this level, because I've taught this same paper for 20-something years, this method is not the method that I shall recommend. I shall always recommend the longer approach. It makes sense. So this one, sahau, feature hii katika kaburi la sahau namna hiyo. Sasa angalieni hapa. Now, question 2 or illustration 2 now. Illustration 2. So illustration number 2, they have given us profit before depreciation and tax, a gain of 10. Then they have given us depreciation of 3. But then in this case here, tax, wamesema ni 0. Tax rate is 0. Tax has not been given. Tax is 0. And then in this case here, they're asking you to give what we call cash flow. Thank you so much, Maslin. Great. So they want you to give cash flow. Are you able to give me this cash flow? I'm giving you 3 minutes. 𝑪𝑰𝑭𝑨, I thought 𝑪𝑰𝑭𝑨 is supposed to be at the intermediate level. Amefika aje hapa 𝑪𝑰𝑭𝑨? Ama we shall overcome. And you seem to be really participating at this level, which is really good. Nawazuia. Hebu nifanyeni hesabu haraka. Remember what we said. If tax is zero, depreciation is zero, and whatever profit you have here becomes the cash flow, isn't it? Yeah. So because even if you try doing this using the longer approach, even if you try doing this using the longer approach, I mean, you'll get the same thing using the longer approach. Solution. So this PBDT is 10. Come and say less water depreciation over how much? Of 3, isn't it? You get 7, right? So this will be profit before tax. Less tax, which is comfortably what here? 0. So 7 minus 0 gives me what here? 7. Yeah, then so this first of all, because first you must arrive at PAT, isn't it? So PAT is 7, and then you come and add back what here? You add back depreciation, isn't it? Over how much here, somebody? Of 3, which gives us what figure, somebody here? Which gives us 10, isn't it? Which gives us 10. And this is your cash flow, which equals what here? PBDT. PBDT. So, I mean, there is no reason you should have gone through all this, knowing that if tax is 0, automatically cash flow will be equal to PBDT. And the examiner has really used this concept here to knock down on my AFM students, because the examiner will come and tell you that this machine has been bought for 5 million Kenya shillings. It has a useful life of 15 years. Yeah. And then it is 10% reducing balance. So as soon as it starts, year 1 depreciation, year 2 reduced balance, year 3, up to year number 15. And yet down there, the examiner has told you that tax is 0. When tax is 0, don't dare to calculate anybody's depreciation, not unless you want to see what we call 𝑪𝑷𝑭𝑴. Yeah. It ambayo inakuwa international what disaster. International disaster. Then let me ask you a question before I start doing, in this case here, a question. If you're told here as an illustration here, that the cost of the machine, for example, that you have bought is 10 million. And then you are told working capital is what here? Is 5. And then you are told here scrap value is 3. Scrap value is 3. Yeah. So in this case here, you are told you are required, ladies and gentlemen, to give us number 1, the initial outlay. And then number 2, yeah, these are the small things that this examiner will always hit you with. So they want you to get the initial outlay, and then number 2, you give us the terminal cash flows. Terminal cash flows. So the cost of the machine that you're buying today is how much? 10. Then there is a working capital of 5. Scrap value has been given as 3. Required, they want you to give us the initial outlay, and then number 2, you give us the terminal cash flows. So you see, they want us to assume that you did this in financial management, which is okay. Of course, you must have done. But some of you did financial management 6 years ago. Ulifanya mwagadi 2016. So I'm talking about you, don't worry. That's why I have to redo this with you before I start my main topic here. So then I would expect you to calculate for me the initial outlay. There is a 𝑪𝑰𝑭𝑨 who did her financial management in 2012. At least somebody is beating you in this game. You're not the oldest here. So initial outlay, let me do the first one for you. So initial outlay, in this particular case, ladies and gentlemen, it will be the my cost of the machine. Of course, initially will be required to pay 10, isn't it? And this machine cannot operate itself. You need some working capital. Yeah. So in this case here, you add WC. WC stands for working capital. So we add WC. So when I add WC, what am I getting here, somebody? 5. So this gives me 15. Yeah, 15. So cost of the machine, and then you add working capital, changes like that. You add working capital, changes like that. So this may seem basic, but very important. And then go ahead, ladies and gentlemen, and do for me, when we terminate the project, what happens when we terminate the project? So terminal cash flow, I will, of course, in this case here, I will enjoy the scrap I will scrap. I'll enjoy the scrap. The machine is old, I sell it. Yeah, I sell it. So I get, in this case here, scrap, I get 3. And then don't forget, not unless you're told otherwise, we must always add released working capital, because working capital will always be released back. The working capital will always be released back. So that working capital that you injected at the very beginning, itarudi kwako ukiuza machine. Ukitoka biashara, working capital itarudi kwako. Now working capital, not unless you're told otherwise that there is inflation in it, working capital will always remain the same. So 3 plus 5, this gives me what here? 8. 8. 8. So this is very, very important. And now we go straight away to our handout, which I've sent today. Have you gotten it? These are handouts that I've sent today. Have you gotten it? Yeah. Haiko kwa, imetumwa kwa email. Imetumwa kwa, ama imetumwa wapi? Kuna mwanafunzi mwingine hapa mpaka muongeza kwanza kwa WhatsApp, eh? Kwanza mtamuongeza kwa WhatsApp. Abracadabra. Abracadabra. Hii ni muongeza illustration. Kila wakati lazima naongeza illustration, eh? Because by the end of the semester, I shall be able to have one booklet of notes. And I need to start now giving these page numbers, eh? Yeah. So I want us to do this question here. Yeah, best case. I wish I'd put page numbers. 3, scenario analysis. Scenario analysis. What was that? Yes. AFM ninja hauko. Adamu andike namba kwa. Tupatie tu kwanza kwa email. All right. Ya ule ambao ni rahisi zaidi. Okay. Great. So are we ready? Are we ready? The physical students not yet kidogo. Are we ready? Are we ready? The online students are washapata already. Jacqueline Korir. Great. Ukipatia huyu atafungua kwa hiyo nini yao. Great. So then I would want us to be reading slowly. Yeah, this scenario. Like the scenarios in the movie, the scenes. The scenes. The scenes. The scenes. Scenario analysis. So definition, this scenario considers multiple variables simultaneously. Remember, sensitivity analysis was looking at the variables one at a time. Scenario looks at those variables changing simultaneously by creating scenarios such as optimistic, most likely, and pessimistic outcomes. The purpose is to show the range of possible outcomes under different circumstances. Advantages, we'll be able to read this, captures interdependencies among variables, provides best case and worst case outlooks. Limitations, those scenarios again cannot be very many. Limited to few scenarios. Does not provide probability distribution. A simple sensitivity analysis assumes that variables are independent of each other and we normally vary them one at a time. Scenario analysis therefore considers all these variables changing simultaneously to give a particular scenario to the managers. This behavioral approach is used instead of sensitivity analysis to evaluate the impact of various circumstances in decision making. It normally provides three different types of scenarios. That is the worst case. This is a pessimistic view of likelihood of future variables to change to the worst. So I'm going to get into this business of a college. What if I will not be able to get even one student at the very worst case situation? How will my NPV look like? Then we have the base or the average scenario. This represents the average and most likely of each variable. It represents what the analyst believes that is most likely to occur. And then we have the best case scenario. This is an optimistic view of the likely future events, and it represents the best reasonable estimates of each occurrence. Assuming that everybody now has gotten, leave those merits, I'll be able to read them later, the merits later, I want us to go to the illustration down there. But the sister hasn't yet gotten this question, illustration, or it's moving around. So I'll be able again to read it slowly. Illustration, Omena Limited. Yeah, best food ever. Omena Limited is a firm in the manufacturing industry. The management of this company is considering purchasing a new machine costing 125 million. This investment is expected to reduce manufacturing costs by 45 million annually. So every year, because of this machine, we're going to save 45 million. The firm will need to increase its net operating working capital by 12.5 million when the machine is installed. But the required operating working capital will return to the original level when the machine is sold after 5 years. Omena Limited will use straight line method to depreciate the machines, and it expects to sell the machines at the end of 5 years, operating life for 11.5. The company pays corporation taxes at the rate of 30% and uses 10% of capital to evaluate projects of this nature. Please, they have told us tax is what percentage there? 30%. Whenever you see tax in AFM, you must always calculate depreciation. If tax is not given, don't calculate. But whenever you see tax, like in this case, the examiner doesn't love you, you must calculate depreciation. So they want us to give them part A, the project's net present value. Project's net present value. So this is a very, very simple question. So first of all, we shall calculate the various types of cash flows that we have. Yeah, so because I've seen tax rate, I will want first of all to calculate depreciation. Have they given me the basis of depreciating? Straight line method. Whenever they are quiet, we shall always use straight line method. All right, so we start with the depreciation, and I'm repeating for the umpteenth time. Why are we calculating depreciation? It's because tax is provided. Yeah, so come here and calculate depreciation for us. So depreciation straight line, they want us to take the initial cost minus scrap value divided by n, isn't it? Remember, whenever you are calculating depreciation, you don't bring issues of working capital. I've never seen working capital being depreciated. Only in exams, when we are matching scripts of students, you'll get so many of them bringing working capital. Working capital will be, say if it's 5, it will be released as 5. It shall never be depreciated. So in this question, is there somebody who is able to see initial cost? Remember, this is straight line. This is straight line method. Straight line method. You can just write like that, and then you underline. Now to get depreciation per annum, we are taking initial cost minus scrap value divided by N. So there is only one ninja who is telling me the initial cost is 125 million. I shall cut the millions. Only one ninja has been able to see that this 𝑪𝑰𝑭𝑨 machine is going to cost 125 million. And the scrap value, my good students, scrap value, when we sell this machine, they have given us a scrap value of 11 point what? Are you able to see the scrap value? William alone. When we sell this, so it is 125 minus scrap value. Scrap value, which is equal to, have you gotten the question paper now? Scrap value. I'm waiting to hear from you, ninjas. I don't want to do this question alone. I always like working with my students step by step. Scrap value, according to Jacqueline Correa, she's getting 11.5. Is that okay? Yeah. Divided by a number of years, how many years is it taking us to reach this scrap? 5 years, isn't it? Wanafunzi wa physical hawanyamazangi sana. Ukinyamaza hivyo hawajapata question. Hawajapata question. Si kawaida kunyamaza sana. Hamjapatia mgeni hata question paper. So in this case here, remember the initial cost of the machine is 125, and should we sell it after 5 years, we are told we shall sell it for 11 point what year? For 11.5. And in this case, the machine is gonna be with us for 5 years. I repeat the last paragraph. Omena Limited will use straight line method to depreciate the machines, and it expects to sell the machine at the end of the 5 years operating life for 11.5. Yeah, 5 years. So divided by 5. So then at the end of the day, what figure are we getting here, my friends? 125 minus 11.5 divided by 5 gives me, according to Elizabeth, she's getting 22 point what here? 0.7. Yeah. So in this case, then once I get this, I will be able to go very fast, and then I give my examiner the operational cash flows. So the operational cash flows, so we have here profit before depreciation and tax. This will be the savings. So operationally, this machine will help me in this case here save how much? Once we start operating it, we've seen there is some savings which will happen there. Once we start, ladies and gentlemen, operating this machine, they have told us somewhere there. They told us somewhere there. There is a place they have told us, yes. Actually, third sentence. The first one is Omena Limited. The second sentence is the management of this company. The third one, this investment is expected to reduce manufacturing cost by 45. That is what we expect to save. Should we bring this 𝑪𝑰𝑭𝑨 machine? So these savings, always, please listen. Whenever you hear of the word savings or contributions, know that that is increase in profit before depreciation and what year? Tax. So now that I have that, I will come and less what year somebody? Depreciation of how much? 22.7. What shall I get here? We'll be able to get what we call profit before what year? Profit before tax. I shall be able to get profit before tax. Profit before tax over how much? Because depreciation already we have gotten, right? We have already gotten this. So 45 minus 22.7. 22.3. Thank you so much. Yeah. So then from there we come and less who? We less who? We less tax. CPA students always assume that tax is 30%. At times, examiners will give you 25%. You must read the question just to be sure about the rate of tax. So what is the tax rate given? Here it was very simple. It was 30%, isn't it? So 30% of this 22.3. Give me a number. Yeah, 30% of this 22.3, which is the same as 0.3. Yeah, so Bwana Lincoln, this Lincoln Ninja seems to be very good. Maslin, thank you so much. Yeah. So my physical students, is there somebody who is able to see 6.69? Uh-huh. I hope I'm not very fast because I don't want to leave anybody behind. So in this case here, we have our taxation of 6.69. Thank you so much. And then now we are able to get our profit after tax. We are able to get our profit after tax. Profit after tax, how much? 15 point. Thank you so much, Elizabeth. Thank you so much, A1Jiko. 15.61. Yeah, 15.61. Thank you, and thank you very much. So having gotten this profit after tax, because of the size of my board, I have to write somewhere. I have to write somewhere. So now that we have profit after tax, ladies and gentlemen, I'm squeezed board-wise because of the camera. Eh? So profit after tax is 15.61. So we come and add back non-cash, isn't it? So we add back who depreciation over how much, ladies and gentlemen? 22.7. Like that. You are adding back for you to get what we call cash flow. We are adding back for us to get what we call operational cash flow. We are adding back for us to get operational cash flow, which in this case is 38.31. 38.31. Now remember, we have three types of cash flows. We have cash flows we get through operations. We have our initial cash flows when we start. And then lastly, we have terminal, when you die, terminal. So now we have, in this case here, operational. So can you kindly go and give me the initial? Please go ahead and now give me the initial cash flows, what we need during the very start of this venture. So initial cash flows, what kind of cash flows are we looking at? Give me examples of initial cash flows. There are normally two initial cash flows. There are normally two. What kind of cash flows are we going to consider? We shall never forget those two types of cash flows. Yeah, the cost of the machine. That's very important. So machine cost, and then we add what we call working capital. Never forget working capital at the start. Yeah, machine cost. Are you able to see the machine cost in this question? Machine cost. Are you able to see the machine cost in this question? We are overcoming. We are overcoming. Machine cost, we are overcoming. Machine cost, we are told the Omena machine here is costing 125. So the Omena machine is costing 125, and then we need WC. We need working capital. We need working capital, which was given somewhere. So you can liota. Lakini kuna mahali tumeambiwa, the firm will need to increase its net operating working capital by 12.5. Yeah, so 12.5. Those two by 12.5. 12.5. Thank you. So come and add this. This will be our IO. IO standing for initial outlay or initial cash flow, initial outlay. So the initial outlay, according to my online ninjas, they are getting initial outlay of, no, they haven't yet gotten 137.5. 137.5. Thank you very much. Then we have the very last cash flow. The very last cash flow, don't forget this, never forget this. It is the terminal cash flow. Yeah. Problem? Please ask questions. But are you able to follow? We shall overcome. So initial cash flow, we are looking at the cost of the machine and the working capital, because the machine can't operate itself. You need people, you need stocks. So IO stands for initial outlay or initial cash flow. It's good for you to be able to know this. Yeah, Jacqueline already has been able to identify the terminal cash flows. They're normally two. Number one, we have the scrap value. Is there somebody who is able to remember this scrap value? Yeah. 100. 11.5 is correct. What else shall we bring here? Oh, the question, you haven't gotten hapo under scenario. Under scenario, butafuta pole pole. Karibu tumalize. Next time I'll give those page numbers. Kuna illustration under scenario analysis. Sorry for that. Under scenario analysis, you'll see illustration. Under scenario analysis. Under scenario analysis. Okay. So like here, if you look at that question, madam, very well, there is a second paragraph. This second paragraph starting with Omena Limited uses straight line method to depreciate the machines, and it expects to sell the machine at the end of the 5 years for 11.5. So when we sell terminating, we are going to get scrap value 11.5. And then when we terminate this machine, we're going to have the working capital which we injected in here, returning back to us. So we have here add, released, working capital. Are you able to remember the released working capital was how much? 12.5, isn't it? Yeah, so you add here. So you have what we call the TC, terminal cash flow, which will end up giving us what figure? Terminal cash flow will end up giving us what figure? So the terminal cash flow, according to the online ninjas, they're telling me it is 20 what year, somebody? It is 24. 24. Now then once I reach there, I'm at home. Because now I have my 3 types of cash flows. Cash flows at the beginning, in between cash flow at the end. 3 of them. So now what I need to do is to come and give my examiner the net present value. So how do I get net present value? It's very easy. So net present value will be equal to, what was our operational cash flow? The operational cash flow was 38.31. Do you remember this figure? Now this 38.31, am I going to receive it only once or many times? Remember the operational cash flow came from the savings. And those savings, they told us for 12 million were being earned every year, annually. So meaning that this is an annuity. So when it comes to discounting this, I will discount this using PVFA. So this is a cash inflow. We also have another cash inflow coming as a terminal. But the terminal cash flow is terminal cash flow an annuity really. Am I going to get every year this figure? Terminal is only received once. So in this case here we say plus 24 multiplied by PVF, because this is a lump sum amount, irregular lump sum amount, PVF. And then now we come and they say minus the initial outlay. So we say here minus initial outlay, Initial outlay is never discounted because initial outlay will be in card today. Initial outlay is never discounted. It will be in card today. Allow me to repeat something here. We are saying that this will be 38.31 times PVFA. Can somebody in this case here give me the cost of capital given in this question? Are you able to see the cost of capital given in this question? Well, it's what percentage? 10%, you're right. So in this case here, this is 10%. And this one will be enjoyed over how many years? 10% for 5 years, isn't it? Yeah. Plus this 24 times PV, still 10 years, but 5th year. Minus initial outlay. Initial outlay, you guys are giving me a figure. This one will not be discounted. So it is 137.5. So now our role will be to look for these values. Yeah, and I'll always advocate for you remembering the formula. Remember the formula of PVFA is 1 minus 1 plus R raised to negative n. Everything divided by R. R is the cost of capital, the required return. So in that case here, then PVFA will be 1 minus 1 plus 0.1 raised to negative n, 5 years. All of the required return, which is our cost of capital, which is 0.1. So please, once you reach here, you need now to get out your powerful calculator Of course, I'll be showing you how to get this from your tables, but in this level, we need to know how to calculate this from for ourselves. For ourselves. So in this case here, get out your calculator. I would want to see you how you're raising. Get out your calculator. This is 1 minus 1.1 raised to minus 5 divided by 0.1. So somebody known as Lincoln is getting 3.7908. Is there somebody who is able to get this figure? 3.7908 for PV-FA. For PV-FA, Nekesa has confirmed. I'm giving you guys 2 minutes and ensure that you are able to get that figure. So this time the online guys have been able to see. Then come here. I also want what we call PVF for the lump sums. So PVF for the lump sums formula is 1 plus R raised to negative n. So then this one will be 1 plus 0.1 raised to negative 5. 1 plus 0.1 raised to negative 5. So are you able to tell me what this answer at the end of the day will be? Are you able to tell me what this answer at the end of the day will be? So 1.1 raised to negative 5. Please talk to me. Please talk to me. Please talk to me. Online students also talk to me, please. Yeah, this is very easy. 0.6209, isn't it? Then go back to our formula of net present value. So go back to our formula of net present value. Yeah, net present value, remember we said it is this 38.31. It is 38.31 times PV-FA. And the PV-FA, you have given me an answer. It is 3.7908 plus this terminal cash flow of 24 times PV. PV, which happens to be 0.6209, minus the initial outlay of 137.5. So then this one here will be equal to what at the end of the day? This one will be equal to what at the end of the day? Because what I've done is to plug in the numbers. What I've done is to plug in the numbers. What we have done is to plug in the numbers. Sorry, yeah. So what answer are we getting at the end of the day? 22.6. 22.6. 22.6 something, isn't it? So all of you will be losing 1 mark. All of you will be losing 1 mark. The sound is too low. Oh, okay. How about now? Because from my side, it's really good. From my side, the sound is really, really good. Perfect from my side. How about now? Are you ninjas able to hear me well? The online ninjas, are they able to hear Mwalimu well? Am I international? It has improved, eh? Okay. Okay, great. So then you would have lost 1 mark because you have not commented about NPV. Whenever it's positive, you say the project is viable. You get 1 mark. And for AFM, it's really, really good. 1 mark can make you see places you've never seen before. 1 mark can make you see places that you've never seen. So number 1, 100% comfortable. Now we look at number 2 of that question. Let's look at number 2 of this question. Let's look at number 2. So number 2 of this question was really interesting. I like this number 2, I like this number 2. So part B, the firm's management are unsure about the annual savings. Yeah, about the annual savings in operating costs that will occur with the new machine acquisition. The management believes that these savings may deviate from their base case value of 45 by as much as a plus or minus 10%. Determine the net present value of the project under both situations and comment on the sensitivity of this variable. Sensitivity of this variable. Ladies and gentlemen, please remember, this is scenario analysis. Under scenario analysis, you're going to get 3 NPVs. Under scenario analysis, you shall give us 3 net present values. You shall give us 3 net present values under scenario analysis. Scenario analysis. So in this case, you shall give us base case NPV that you have given me as 22.6 something, isn't it? The one you have, the original one, the one you have calculated is 22.6. Yeah, that is base case NPV. Then you must come here and give me the best NPV. Best case NPV. You must come here and give me the best case NPV. 3 of them. Yeah. And then we have in this case the worst case. Worst case NPV. Worst case NPV. The worst case NPV. So in this case here, for you to get the best and the worst, you must look at the percentage variation given. They have told us to vary this variable by what percentage? 10%, yes. So 10%. So then let's start with the best case. So best case, we shall increase savings by 10%. Yeah, you see, when our savings improve, that is good for us. So we improve the savings by what percentage? 10%. So remember, our original savings were 45, isn't it? So the new savings will be equal to what? So the new savings, if you're going to increase the savings by 10%, what will be the new savings for us? Abracadabra, patapotea. Patapotea. Remember the old savings, the PBDT was 45. Now we are being told to improve this by 10% to go to the best. 49.5. Yeah, because it will be 45 times 110%. Or you get 10% of this 45, then you add it. So I'm being told in this case that this gives us what here? 49.5. Then I would want to give you exactly 5 minutes. Now, out of this best case savings, please go ahead and give me the best case NPV. Depreciation doesn't change. Tax is not changing. So you're going to get the cash flows the normal way. You get the cash flows the normal way, everything normal, and then you advise. And then you need to talk to your friend. Of course, if you are online, you don't have a friend seated next to you, which also is very, very good because you can talk to us through WhatsApp, etc. So now remember, we are working with 49.5. Why am I using 10%? It's because they have told us that the variation is 10%. The variation is 10%. Yeah, the increase because we are working with best case. So I'm giving you exactly 5 minutes. Try your very best and give us the new net present value. New net present value. Answers are we able to get in this case here for the best case scenario? Wamenyamaza sana. Best case scenario, what answers are they able to get? Is there anybody who is able to get 34 point something? Yeah, 34.6, yes. Did you move on to get the worst case ama mlikuwa hapo? Ama unafanya ile homework ambayo mwalimu amepatiana peke yake? You must be very good people. So in this case here for the best case scenario, ladies and gentlemen, remember the most important thing is to get your cash flows, which will be discounted. So here we have our best case. Yeah, best case cash flows. So we start with our savings. And this savings here will be our profit before depreciation and tax. So it is 45 times 1, 10%, which gave us 49 point what here? 49.5. Then we'll come and less what here, or rather tax first. No depreciation, in the method of Missouri. Of what, yes, that doesn't change. Of what figure? 22.7, which gave you guys profit before tax of how much here? 26.8. And then you come and less what here? Tax. What percentage here? 30%, isn't it? Which 30% of this gave you guys what figure? 28.04. Thank you very much. So you subtracted, and then you got what we call profit after tax, which gave us what figure here? 18.76. Then you come and add back what here? You add back depreciation, mwanafunzi mgeni mzuri sana huyu, which gave us 22.7, which in this case here then gives us cash flow. Cash flow yangapi? 41 point. And then if you are careful, you must have realized that the other cash flows were not changing at all. The other cash flows weren't changing at all. So then what we need to do is to come here. Yeah, TM, I like what you're telling me there. I'm so sure nobody has remembered to comment. Oh, okay. Great. So then you'll be able to come here and give us NPV, which is best case for best, which in this case, ladies and gentlemen, will end up giving us what here? So this is 41.46. Do you remember the PV-FA? The PV-FA was 79. Do you still remember that we have some terminal cash flow? Over how much? 24 times PV-FA of 0.6, 209, minus the initial outlay, which will not fluctuate, 0.5, which then at the end of the day will give us what figure? 34.56. So this gives us 34.56 in this case here, which is positive, isn't it? So the project is what here? Viable. The project is viable. And then once you get this best case NPV, please go and give us the best or other percentage change of best NPV. So in this case here, we'll take best minus old over old times 100. Old or original, one and the same. So you take best minus old over old times 100. So the best NPV, you've given me a figure of 34.56, right? Yeah. Minus the old one. Old is the original. The one that we got up there. The one that we got up there, that was the old. Somebody who is able to remind us that figure. The one that we got up there, ladies and gentlemen. 22.62. Divided by the old one again, 22.62. Whatever answer we shall get times 100. Whatever answer we shall get times 100. So what figure are we able to get at the end of the day here? So in your calculator, you say 34.56 minus 22.62 equals divided by 22.62. Whatever answer we get, we say times 100. So admin is getting 52.76, Elizabeth. 52.77 or 76. Thank you so much. Is there somebody who is able to get this 52.77%? 0.7? 52.77, right? Yeah. So from there, then we shall be able to move forward, ladies and gentlemen, not unless there is a question, we shall be able to move forward to the worst case now scenario. So go straight away to the worst case scenario. So if things don't work for us, the worst case, what do we expect our savings to do? To go down, isn't it? To go down by 10%. So they go down by 10%, that will be akin to multiplying this 45 by 90%. 90%, because now things are not working out. Under the worst case, this will be our savings. And don't forget that this savings is PBDT, right? PBDT. So 45 times 90%, that will end up, the CASA is giving me a figure of 40.5. So we have 40.5 here. We have 40.5 here. So once I get that, I know what I'm supposed to be looking for. I will come here very fast. I less what here, somebody? Depreciation fast, yes. We less depreciation. Depreciation doesn't change because this other factor is changing. No. Depreciation figure, you guys are giving me a figure. I know now you're writing very fast because you're ahead of me. Depreciation, it was 22.7. So this was 22.7. You come and subtract like that, and then you'll be able to give us what we call profit before tax. You'll be able to give us profit before tax. So profit before tax, according to this gentleman, they're getting 17.8. They're getting 17.8. Once I get this, I will be able to tax this right away. So tax at 17.8 by 30 will give us what amount? So 17.8 times 30. The online guys sasa wameanza kwenda pole pole. Online guys wanaanza kwenda pole pole. 5.34. 5.34. So go ahead and subtract. Once you subtract, you'll be able to give us profit after tax. So once you subtract, you'll be able to give us profit after tax. So our profit after tax, ladies and gentlemen, will be this 17.8 less 5.34, which will give us what figure? Somebody has profit after tax? 12.46. So this 12.46, we shall do abracadabra and add what? We add back depreciation, isn't it? And this figure you had actually given it to me, it was 22.7 years. So come and add back, and then you get your cash flow. Add back, and then you get your cash flow. Add back, and then you get your cash flow, which will give us what figure? 35.16. And then you go ahead and now discount. You go ahead and discount. Go ahead and give me net present value, which in this case here will be worst case. The worst case. Worst case. So worst case, ladies and gentlemen, it will be this cash flow, which I'll be getting every year, right? Times, in this case here, my PVFA. PVFA, you'll be able to remind me the figure of PVFA. 3.7908. Plus, in this case here, that's scrap, the terminal. The terminal had given me a number, if I remember very well. The terminal had given me a number, if I remember very well. 24, eh? So 24 times who? 0.62. Yeah. In this case, you remember the initial outlay is an outflow. It has to be subtracted always. The initial outlay was an outflow. It must be subtracted always. 137.5. Yeah. So then this one here will end up giving us what net present value? According to Lisa, 10.686. 10.686. Even if you're not asked, please always make a comment. If it's possible, viable. If it's negative, it will be not feasible, not viable, not viable. And then give me the percentage change of worst, which will be the worst minus old, all over old, times 100. Yeah, you use always that approach, best minus old over old. This one will be worst minus old over old. So the worst figure that we have here, the worst NPV you guys have given me is this 10.686. Then we say minus the old figure. What was the old figure? Oh, they're not with me. 22.6, 22.6, all over the very old, which is 22.6, isn't it? Whatever answer we get shall be multiplied by 100. And then remember, in terms of percentage change, we are interested with the modulus. We're interested with the number, not the sign. That's why you will see whenever you get the sign being negative, you do like this. Because you want the percentage change. You don't want the direction. So according to admin, the percentage change, so you ignore the negative. Whenever you get percentage change negative, ignore it. All percentage changes will be positive. So you're getting 52.7. 52.7%. So could you kindly remind me, ladies and gentlemen, what was the percentage change for best? Best, it was 52.77. How about this percentage change for worst? 52.71%, like that. So remember, the risk, normally we look at the risk whenever the worst is bigger. You know, when you spring towards the worst, that's when we say it's risky. It's risky. So this one is kind of balancing, but for us to be able to, ladies and gentlemen, in this case here, just, no. This is percentage change best. This was percentage change. The second one is worst. So this is worst here. Worst, yes. So in that case here, we can see that worst is less than what here, somebody? Best, implying that the project has a lower risk. The project or the variable has a lower risk. Has a lower risk. So whenever worst percentage is less than the best percentage, you see that the project or the variable has a lower what here? Has a lower risk. That's how you do the interpretation now. So under scenario analysis, ladies and gentlemen, what are we required here to master? We are required here to master the concept of what here? The concept of the three scenes. The three scenes. Once you understand the concept of the three scenes, you will never go wrong. Never, ever. You'll never, ever go wrong. Now, so we have illustration number 2 there. Illustration number 2 is your homework. Never, ever ignore my homeworks. Never, ever ignore my homeworks because unajipata shida. So nakupatia homework na iko na mpaka solution. Iko na mpaka solution hapo chini. Hiyo homework na iko na mpaka solution. Unang'ang'ana nayo kabisa. I've even shown you how to get percentage changes like that. Now, within the time that is left, the thing that we can easily finish here is what we call certainty equivalent method. Yeah, the 7th method. Sijui itakuja page namba ngapi hiyo, the 7th method. It's called the certainty equivalent method. So for you can call it method number 3 or method number 4. Yeah, certainty equivalent method, whichever. Certainty equivalent method. I can't introduce the trees right now. We have very few minutes. Certainty equivalent method. Or certainty equivalent cash flow method, one and the same. Yeah. So sasa kuacha nyuma, nataka nyote mconfirm kwamba kwa hiyo handout mnaweza mkaona hiyo page. Kama mshafika hapo kwa mwisho kwa certainty equivalent, inakuja page namba ngapi kwa simu? Certainty equivalent method inakuja page namba kwa simu inaonyesha hapo chini inaonyesha number 5 number 9. Thank you so much. Number 9. Sijui kama tumepata sisi wote, tuweze soma kabla tuseme tumepata sisi wote. So certainty equivalent method converts uncertain future cash flows into certain equivalents by applying a risk adjustment factor, then discounts them at a risk-free rate. If I do it that way and leave it that way, you can't understand anything. For you to be able to understand what I'm talking about, my good students, let's look at this illustration number 1. So illustration number 1, they've given us the time there, 0 up to 3. Then we have the cash flows. Then we have the certainty equivalent coefficients. Are you able to see that? Additional information, cost of capital is 10%. So required, calculate NPV using certainty equivalent method. So this is really easy peasy. How shall I do this? Number one, copy the table the way it is. So we have time, right? So time, we have 0, 1, 2, 3. Yeah. Then we have our cash flows. We have our cash flows. So our cash flows, what do we have here? We have 20, 20. Then we have, 10, 12, and 15. 10, 12, and 15. Yeah. And then we have what we call the CEC, the certainty equivalent. No, talk of certainty equivalent coefficients, for you to remember this. Certainty coefficients. So you can see the first one there is 1. The first one there is 1. Second year is 0.85. Third year is 0.9, and then 0.92. Thank you so much. 0.92. So first of all, you copy up to there. That's the first thing that you do. That is the first thing that you do. That is the first thing that you do. You copy up to there. You simply copy the table the way it is. After you copy this table the way it is, now you start solving using the concept that we learned up there. So you see, these are cash flows that we are not certain of. But you've given, in this case, actuarial scientists, they've been able to do their probabilities. They know, for example, like this year, you expect 85% of this. We are certain up to 0.85 or 85%. So then come and give us what we call certain cash flows. Give us the certain cash flows. How do you get certain cash flows? You take this times this to get certain cash flows. Now we are certain, we've been able to remove the uncertainty because now we have involved, in this case, the certainty coefficients. So you give us what we call certain cash flows. So certain cash flows, what do we have here? Minus 20. Remember, times 0, it will always be minus, Not unless you're a thief. At times 0, you're investing. You're buying a machine. Yeah, you're buying a machine. So minus 20 times 1, this gives us minus what here? 20. 10 times 0.85 gives us what here? Somebody 8.5. 12 times 0.9. That one you have to give me an answer, really. That one you must give me an answer. That one you must give me an answer. 10.8. So this gives us 10.8. And then we have 15 times 0.92. So 15 times 0.92. So that will end up giving us what figure? 10.8 again. 13.8. 13.8. Now from there, remember these cash flows are the ones that you discount. So discount certain cash flows. Discount certain cash flows because we are certain about them, using risk-free rate cost of capital. Using risk-free rate cost of capital. Using risk-free rate cost of what here? Cost of capital. Using risk-free rate cost of capital. Why are we using risk-free rate? Because there is no risk anymore. We have removed the risks. So remember, in the normal exam, you'll see, like, I'll start doing your past paper questions here. They'll give you the normal cost of capital. Then they give you the risk-free rate. If you forget and discount using the other normal cost of capital, you get a 0 the entire question, because here we are certain there are no risks. So in this question, of course, they never differentiated. They never gave us any different cost of capital. So we shall use the single one which is given there, which is cost of capital, which is what percentage there? 10%, isn't it? Cost of capital is 10%. So then we want now to get our discounting factors. So discounting factors, talk to me. Discount factors. Do we use PVIF or PVIFA? PVIF. Why? Because these cash flows are fluctuating. They're different. These cash flows. Yeah. How we got certain cash flows. Remember, we have this cash flow, the normal one, the irregular one. These ones here, these are uncertain. And then we've been given by the examiner the certainty coefficients. So then what we did to get certain cash flows, we took these cash flows times these certainty coefficients like that. So like the first one minus 20 times this second one, this time this was 8.5. That's what we did, Bwana user. I hope you've been able to see. So then the formula getting PV, ladies and gentlemen, we know it. We know the formula of getting PV. Honestly, we know it. We know it. We know that to get PV, we take 1 plus R raised to negative what here? Negative n, isn't it? Yeah, and the R is 10%. So we have here 1 plus 0.1 raised to negative 0, 1 plus 0.1 raised to negative 1, 1 plus 0.1 raised to negative 2, 1 plus 0.1 raised to negative 3. We shall be using our tables, but for now, let's just try to use, first of all, the calculators. Or I explain what PV and PV are and how to get them. Yeah, I'll be able to do that, Julius. That's your right. You don't even have to use please. That's your right. I'll be able to explain just in a minute. I'll be able to explain. So you see, we normally use PV whenever we have irregular. You see, like now this, we are putting in this, we get a different amount, different amount, different amount. PV stands for present value interest factor. Present value interest factor. And we normally use PV to discount irregular. And those ones which are irregular are the one now we are using this PV formula, which is 1 plus R raised to negative what here? Negative n, where R is the cost of capital, N is the year, the time period. So R, the cost of capital has been given here as 10%. So we have here open brackets 1 plus 0.1 raised to negative times 0 here. Yeah, this one here must have given you 1, isn't it? This one here must have given you 1. I'll be able to explain Julius the other one. So we come to the second one, 4 decimal places. So what figure do you get? 0.9091. And then this one here will be 0.8264. And then lastly here, 0.7513. Yeah. And then now you come and give us what we call DCF, discounted cash flows. So discounted cash flows, you take these cash flows times the discounting factors to get this. So remember, DCF stands for discounted cash flows. So take like the first one is minus 20 times 1, which gives me minus 20. Then we have here 8.5 times 0.9091. 8.5 times 0.9091, which will give me what figure? Oh, the online guys now, I think I lost them. They're not talking to me at all. 7.73. Thank you. Then 10.8 times 0.8264. 10.8 times 0.8264 will end up giving me 8.93. Then lastly, we have 13.8 times 0.7513. 10.37. Then come and add everything, and then you're able to give us the net present value, which we are certain about. Net present value, which we are certain about. So you add everything. Remember, DCF stands for discounted cash flows. DCF stands for discounted cash flows. 7 point. Sorry, 0. 3, yeah, but you forgot to say it's viable because it's positive. Every time they forget, it's positive, isn't it? It is positive. 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 So, ladies and gentlemen, we have got 2 types of cash flows. In finance, we have 2 types of cash flows. We have cash flows that are regular like these ones. And then we have those cash flows where this year will be getting 10, next year 10, next year 10, 10, 10. Those ones we call what here? Annuities. And the annuities, you discount them using what we call PV, which is present value interest factor of an annuity, Bwana Julius. And to get this, remember PV formula. PV formula, tumesema ni 1 plus R, isn't it? Raised to negative what here? N. How about PV for? Yeah, it is 1 minus now this, isn't it? Yeah, 1 plus R raised to negative, and then everything you divide by what here? R, like that. So I hope, Julia, somehow I've answered your question, and we shall continue in this case here, doing this PV first, PVs for so long. Okay. So did annuity due, and the other one, yeah, those annuity due are becoming, I mean, to them very, very soon. Very, very soon, Julius. Yeah, that's okay now. So, ladies and gentlemen, today we have our Thanksgiving Prayers Day, which is starting at exactly 8 p.m. all the way to 10 p.m. So I beg you to excuse myself. You've got work to do, right? You have work to do. You have a homework to do. Finish your homeworks here. Na kama mtapata link, muingie prayers, pate mawaidha ya kusoma. Otherwise, asanteni sana. Bye. Yeah, I'll send the link.